Welcome to Richard Suttmeyer's 4 in 4. 4 blips on my radar screen, presented in 4 minutes or less. Today I put a different spin on the housing and financial sectors that I hope strikes up some needed and heated debate on Capitol Hill. My first blip is my opinion that the Federal Reserve should be the regulator for the primary dealers. In the 1970s, I was a U.S. Treasury and federal agency securities trader in the primary dealer community and periodically attended meetings with the New York Fed's open market trading desk. In the mid-1980s, I helped establish L.F. Rothschild as a primary dealer. The New York Fed is the watchdog of the primary dealers, who are the approved customers of the New York Fed open market trading desk. I think that the Fed missed many early warning stress signals from their approved customers, and I believe that opening the discount window for all primary dealers should be made permanent. My second blip suggests that the Federal Deposit Insurance Corporation should be the regulator for all banks. The FDIC should set the standards for the type of loans that the FDIC-insured financial institutions are allowed to create and underwrite. Community banks, which I describe as banks with assets below $10 billion, should serve their communities and not speculate in underwriting loans outside approved geographic areas. Under FDIC-approved supervision, the community banks that exceed their guidelines should be forced to either raise capital or stop originating the type of loans that exceed the guidelines. 2,368 banks are overexposed to construction loans, as shown in this FDIC table going back to 2003. The regulators floated risk guidelines in the fall of 2005, which were ignored. Congress should get ahead of the expected wave of bank failures by establishing a national FDIC bridge bank that allows local branches to be formed when a suitable surviving bank cannot be found. My third blip suggests the nationalization of GSEs within the U.S. Treasury Department as their regulator. Fannie Mae and Freddie Mac are publicly traded companies, and we all know their problems over the past several years. These GSEs are tied to the U.S. government via a modest line of credit, which certainly puts them in the category of too important to fail, just as the primary dealers are to the Federal Reserve. My fourth blip suggests that the use of derivatives should be limited and regulated by the U.S. Treasury. In creating derivatives, Wall Street makes a lot more money than buying and selling traditional and understandable mortgage-backed securities. The sum of the parts is greater than the whole, padding the pockets of investment bankers. The write-downs are the payback when the structures fail. The type of structures that seized up the credit markets need to be abolished. If J.P. Morgan CEO Jamie Dimon believed that the New York Fed approved mark-to-market of Bear Stearns collateral, if he liked those mark-to-markets, he would have accepted ownership of those securities. Instead, he described the collateral as adding to the straws that are already on J.P. Morgan's camel's back. Beware that Bear Stearns' portfolio is the tip of an iceberg. If the CEO of J.P. Morgan doesn't want to own the type of derivatives his bank created, they don't belong in portfolios around the world. As homeowners, are homeowners better off with the new originate, distribute mortgage loans in derivative forms versus the old originate portfolio approach where the loan is a bank asset? This question needs to be answered. The current wave of foreclosure provides a simple answer. To sum it up, the idea that the current regulators are not at fault for the current housing financial turmoil is a bad joke and an insult to U.S. citizens losing their homes. Jim Bunning pitched another perfect game yesterday at the Bear Stearns hearings. I agree with his comment. The red flags have been waving for years. Send your comments and questions to support@rightsideadvisors.com. That's today's 4 in 4. Enjoy your weekend.